Plus.
Part of the risk-on environment has been this renewal in the meme trade. You can see Open Door and Kohl's down today, but Krispy Kreme and GoPro joining some of that action. A longer-term chart, though, will show you how these things sometimes joining some of that action. A longer-term chart, though, will show you how has a note about short interest. Stop trading. These coming up next. Dow's up 140.
.com.
Let's get to Jim and stop trading.
The most reliable medical equipment company. I'm not ISRG. I really like Intuitive. Boston Scientific, another great quarter. Mike Mahoney quietly puts up a fantastic number after fantastic. Big revenue beat. Some people are just so unheralded. And this, again, is the broadening out. I know that we can worry about 2008. I know we can worry about 2021. But there are sectors of the market where the companies are just crushing it. Like that.
Yes, we'll keep an eye on it. I mean, the equal weight versus the S&P has not been doing very well on a relative basis.
I know. I mean, look, and the Russell, not so great, but I just find this rolling bull market. I mean, yesterday was Campbell's Soup and General Mills and stuff. I like it.
You like it. A little bit of concern about some of the areas of speculation as well.
Because I'm going to cut rates so quickly, David, when I get in.
And then mortgage rates will just come down as a natural result.
I'm going to cut teaser rates first. That's
teaser.
the one thing as a Fed chair. I'm going to focus on teaser rates.
Okay.
And then I'm going to give interviews to various people and kind of, am I doing off the record?
Just do me a favor and don't do any renovation.
No renovation.
Just keep the building as it just.
I like it as it is.
Yeah, let it fall into disrepair.
No, it looks good to me. I mean, I feel like there's, like Arthur Burns had that touch. I like it. Look, what can I say? I'm not going to be Fed chair. All right.
Definitively?
Definitively.
I'm not sure about that.
Otis tonight.
Yeah, no, this was the first big miss. And remember, she's a lot China, but you don't see a lot of cranes. There are not a lot of cranes in this country, and let's see what that's about. Yes, I'm worried, but I'm also sanguine. Two track.
That's a good one. I like it.
Calls at 12.
Yeah.
I'm a buyer.
Jim, we'll see you at 6.
Yeah.
Mad Money 6 p.m. Eastern Time. Existing homes after the break.
Good Wednesday morning. Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber, live as always from Post 9 of the New York Stock Exchange. Stocks are rally mode again today, perhaps celebrating the Japan trade deal, which we'll talk about in just a moment. Up a little bit on the S&P. Nasdaq's kind of given a little back, unchanged. We're waiting some big tech earnings. If you look at the breakdown of what's moving right now, healthcare is actually the leading sector, up 1.1%. Industrials also strong. Energy, we've got a few energy CEOs coming your way. Technology, a little bit under pressure, and so are financials ahead of Alphabet, Tesla, IBM earnings. Take a look at treasuries here in the early action. Light data week today ahead of the Fed next week. A little bit of firming of yields here. The 10-year at 4.37, so nothing dramatic. 2-year a little elevated at 3.8. Coming up on today's show, we are getting you set for one of the most important day of earnings seasons with reports this afternoon, as mentioned, from Alphabet, Tesla, IBM. We'll get Chipotle and more. We'll talk to a portfolio manager who counts one of those names as his top holding. Plus, nuclear company Oklo teaming up with oil and natural gas firm Liberty Energy on a new partnership to power large-scale projects like data centers. The CEOs of both of those companies will join us this hour to discuss.
Let's get some existing homes this morning with our Diana Olick. Morning, Diana.
Good morning, Carl. Existing home sales in June dropped 2.7% month to month to a seasonally adjusted annualized rate of 3.93 million units. That's a miss. The street was looking for essentially flat, sales unchanged year over year. Now, this report is based on closings, so contracts likely signed in April and May when the average on the 30-year fix jumped over 7% a few times and never really went below 6.8. Now, on supply, there were 1.53 million units for sale at the end of June. That's up 15.9% from June of last year, representing a 4.7-month supply at the current sales pace. 6 months is considered balanced, so we're still lean. And the median price of a new home sold in June was $435,300, up 2% year over year, and another record high for the month of June. That is the 24th consecutive month of annual increases. Houses are spending longer on the market, an average 27 days compared with 22 last June. First-time buyers at 30%. Historically, they're at 40%. And all cash still elevated at 29% of sales. Sales are strongest on the higher end of the market. That's a change from the spring when the high end was hit by stock market volatility. And just one more thing, Sarah. The chief economist, Lawrence Yun, on the conference call just answered a question about that potential cut in capital gains on home sales that the president suggested yesterday. He said their calculations show that that would affect 15% of current homeowners and largely on the very highest end of the market. Sarah.
Okay, good to get that analysis, I guess, as we digest what that policy would mean. Thank you, Diana. Diana Olek. Big news today in the market and in Washington, the U.S.-Japan trade deal. And just to put it all in perspective, Japan is one of our biggest trading partners in terms of the size of trade deficits, which the president likes to view the world through. It's number 7, just behind Taiwan. Of course, biggest trade deficit is with China, Mexico, Vietnam is in there, Ireland. Buy a lot of our drugs from there, but Japan is right behind Taiwan. There's a little more than $60 billion trade deficit in 2024. And guess what? A lot of that is autos. They ship a lot of autos into the U.S., and this is something the president has complained about, that it's not a two-way street. But look at, here's it's almost 80%. I mean, it's more than 70% of the trade deficit is made up of autos, which is why this was such a key component of this deal. So what do we know so far about the deal? 15% tariff rate instead of 30 threatened. The auto rate was also lowered to 15%, them shipping autos into the U.S. So we collect the tariffs, but it's not as bad for them as originally thought. You know, some other go down to 15%. We sell more into them at no tariffs, and we're talking about agriculture like rice. We're talking about Boeing planes reportedly as well, 100 Boeing planes, hiking defense spending as well. But the centerpiece of this deal, which is sort of interesting to talk about because we haven't seen this in some of the other trade deals, is the $550 billion investment vehicle. It's short on details. We don't know where that money is going to come from necessarily or where it's going to go, but it's an interesting way to get to the president's priority of bringing capital and investment into the United States. Maybe Japan will help fund a data center, for instance.
Yeah, what does that mean?
We don't know exactly. I mean, they haven't spelled it out. But I think one of the instances I read about in some of the reporting of this would be Japanese companies would help to fund a data center company, profits primarily in the U.S., but Japanese companies helping
I
operate.
can think of a Japanese company.
They're going to give us 90% of the profits.
I can think of a Japanese company that's already funding a lot of data centers here. Of course,
Yeah.
SoftBank. I mean, $30 billion to OpenAI alone. I want to hear more about this. And, the president basically wants to structure these things, and then we get the carry on these.
Like a sovereign wealth kind of type investment vehicle.
He did say this morning that he's willing to give up some tariff points for opening up markets. And there has been a lot of frustration with getting U.S. cars into the Japanese market. Although this morning, one of the American Automotive Policy Council represents GM and Stellantis. Any deal that charges a lower tariff for Japanese imports with virtually no U.S. content than the tariff imposed on North American-built vehicles with high U.S. content is a bad deal for U.S. industry. So it's the one bit of pushback we've gotten on this deal so far this morning.
But one of the keys on the autos, and we heard this from Taknami of Suntory yesterday, and it seems like that they were able to reach a deal here, is that they would have the rules would be lightened for U.S. autos going into Japan. Same safety standards and same standards, for instance, as Japanese cars sold in the Japanese market. This is something U.S. presidents have been complaining about for a while when they go over to Japan and they don't see any American cars there. and they only see Japanese. President Obama even talked about this issue. So if this opens up the market truly, that ultimately I would think would be a good thing for a GM or a Ford or
They don't
Tesla.
let in Chinese cars either over in Japan?
Yeah, I mean,
as well?
right, trickier.
Can't get
right?
a BYD there either, I guess, probably.
Yeah, it's a little more restrictive. So that's good, but they have plenty of Japanese cars that they sell to the Japanese population. That's really the competitor there.
Yeah, of course.
By the way, did you see the Japanese automakers in the session overnight?
Yeah,
Up double digits.
We've just been showing some of them,
They have, I mean, they don't have to pay now 25%
which
tariffs.
was a
It's
real
15.
concern in terms of the weakness that would be, given, as you just pointed out, how important the export of automobiles to this market is for them.
All-time high for MSCI Japan.
And Toyota
market.
up some 13%. Still number one, right, in the world? I think Toyota still overall deliveries.
That's probably right.
Yeah.
Right. All right, let's move on to the broader markets here. The S&P 500 is sitting right at a record high. The next big catalysts come after the bell. We're going to get Alphabet and Tesla reporting results. Joining us now is Michael Nicholas. He's Oakmark's portfolio manager. Alphabet is amongst his top holdings. Good to have you this morning. You know what? I want to get to Alphabet, but I notice as well sort of what differentiates your portfolio a bit is you have a big ownership stake. I think it's in Capital One, which reported numbers this morning. Stock is up. I'm just curious, sort of, Michael, what you see in that company and why you're, why it's a significant allocation for your account.
Yeah, we've owned Capital One for quite some time, and I think I talked about the same idea maybe last year on the show, but we thought the acquisition with Discover was going to be very beneficial to them. We thought pro forma for some of the synergies that we had put into our model that the stock was trading at that time at a high single-digit multiple of earnings, and it was good to see some of the results that we saw last night coming out of there, with the net interest margin improving a bit and credit performing quite well. We think it's one of the best run financials that's out there, and continue to be a pretty material position in our fund.
Yeah, they seem to have ambitions, and Jim Cramer was talking about it earlier on our show, sort of globally, and to really take on some of their competitors. You think they're going to be successful in that?
We do think they're one of, just a handful of very scaled competitors that can compete in the card market. It is a good market that if you have the scale, can earn pretty healthy returns. But we do think the integration with the network will put them in a much better position to compete, both domestically and globally.
All right, let's talk a little bit Alphabet, given we're going to get earnings. Down today, but it's up, I think, 10 straight sessions. It's clawed its way back to even on the year, has the stock. One of the main concerns out there, I think it continues, is simply they're losing their monopoly, so-called, in search. How many people now, when they're searching, so to speak, go to OpenAI or one of the other LLMs? Is that not a concern to you?
No, it absolutely is a concern to us. I think a couple of years ago, most people would have been hard-pressed to come up with the disruptive threat to search. And today, I don't think that's the case. With artificial intelligence and maybe ChatGPT in particular, our view is the range of outcomes around Alphabet's search business has widened. We typically respond to scenarios like that by increasing our discount rate or reducing our estimated business value for that segment. But it's important to remember that Alphabet, has been investing in AI for a long time, has a lot of resources to compete there, and frankly is more than just search. I heard you guys talking a little bit in the earlier segment, but when you think about the collection of assets away from search, you have, of course, a large cloud computing business, which should be a big beneficiary of AI if the bull case plays out and adoption continues to increase. But also things like YouTube and Waymo and a number of other bets. Of course, they own Android as well. So we think these other assets account for a pretty healthy chunk of Alphabet's market cap today, with the implication that the market's already applying a very low multiple to the core search business. So, the stock has held in there quite well this year. It's, performing well fundamentally still, but the gap to intrinsic value has narrowed for us.
Yeah. I mean, some of the parts become important here. Obviously, we continue to monitor the cases of the U.S. government versus Google and what the outcome is going to be in terms of any ultimate decisions there. Is that a concern or is that an opportunity in some way?
Yeah, we've always approached our analysis of Google into some of the parts, and I think you have to. There's so many businesses under the hood, some of which are non-earning or under-earning. And if you were to just take the earnings on the face of the income statement and slap a multiple on it, you'd be valuing some of these businesses at a negative that we thought had very positive value. So we've always thought about it piece by piece. And yeah, we are concerned about competition and regulatory, but I don't think it's lost on the market with Alphabet below a market multiple on reported earnings and well below a market multiple on search.
Yeah, I was going to ask to justify sort of the case for value on Alphabet after it's had such a strong run-up, just particularly in the last few months. I mean, you clearly think it's value. And some of the other names in your portfolio, they're financials in your value strategy, like a Schwab and a Bank of America. I mean,
Yeah.
Is it harder to find value in large cap stocks right now with stocks at record highs?
You know, I think if you would have told most people, 3 months ago, when the S&P was down 20%, that we'd be sitting here today back near an all-time high, they probably would have been skeptical. But we're not market timers, and we're always looking for the best positions that we can find within our opportunity set. So, to us, we're not having a difficult time finding opportunities. Now, you look at the S&P today, and there are some risks. You've got concentration risk, which you all have covered quite well. Of course, there's valuation risk at 23 times earnings. And you have style risk with growth outperforming value so demonstrably over the last decade. That might make me sound bearish, but we're really not. We still think the valuation dispersion beneath the surface remains unusually wide, which is an attractive environment for value investors like us. And, we think we've put together a really attractive portfolio at a fraction of a market multiple and with less risk than what's lurking in these indices from a concentration perspective. So still finding new ideas.
All right. We'll leave it there for today, Michael. Thank you.
Thanks.
Here's our roadmap for you for the rest of the hour. Nuclear energy teams up with fossil fuels. We'll talk to the CEOs of Oklo and Liberty Energy about their new partnership to power data centers.
Plus, the CEO of KeyCorp, just out with earnings, is that bank. We're going to get his read on the consumer, bank regulation, a lot more.
And getting constructive on home builders. We'll talk about the surprise strength on names like Horton and Pulte this week, as we just got that existing home print. Pulte the sector actually coming off the best day since 22. Big show still ahead as Squawk of the Street continues.
Happy with it.
Despite a regional bank ETF trying for its fifth positive week in 6, boosted by a slew of regionals reporting results this week, including KeyCorp reporting a clean quarter, raising its net interest income growth outlook up to 22%. Joining us now is KeyCorp CEO Chris Gorman. Chris, it's good to have you. Welcome back. It feels like a pretty
Right.
strong
Good morning.
operating environment for your bank and others. Is that right?
It is. Yeah, it is. We have, we have a lot of tailwinds from an NII perspective, and our interactions with our clients are also favorable. I'm pretty bullish as we look forward.
What are you seeing in terms of client activity, both corporates and
Sure.
individual, personal?
So let me start with the consumer. Our consumer is in great shape. They're spending money in the same manner that they always have. There's very few delinquencies. I think one of the things that the models miss is the wealth effect in the United States. In the last 15 years, there's been about $100 trillion of wealth created. And so I think when people look at things like the unemployment rate, when people look at things like, the labor participation rate, the unemployment rate, I think it misses this wealth effect, which obviously is a significant amount of our economy, and that 70% of our economy is the consumer. So the consumer's in great shape. On the commercial side, it's interesting. As you talk to all of our customers, and I'm out with our customers all the time, they'll always tell you about all the concerns out there that you are very familiar with, but then they'll say they feel pretty good about their business. And so I find a little bit of I'd say they're cautiously optimistic. We take a survey of our top middle market customers, about 850 of them, and a full 50% of them expect this to be a good operating environment for them. So I think we're on a pretty good path. Everyone talks about tariffs, obviously significant. 30% of our customers are impacted by tariffs, yet only about 3% are impacted in a significant way. So I think there's pretty good momentum actually in the economy. And this bonus depreciation for closely held businesses, for private businesses, I think is going to be a big boost to CapEx in the back half of the year.
Well, that's a very positive, optimistic outlook. What do you think happens to rates? I know you raised net interest income guidance. Given that backdrop, where do you think rates go?
Yeah, I've been in the higher for longer for some time. I think, the forwards have a couple cuts in them. We run all of our models based on a couple cuts. I would be surprised if we get a couple cuts this year. I think the economy has a fair amount of momentum, actually.
So Fed may not cut this year. That would really not make the president happy.
Yeah, I think that's a possibility on both fronts.
Interesting. You also have the fee growth was good from investment banking. Curious the sort of sustainability and outlook on that front, and how big of a part of your business that is right now.
So our investment banking business is about 10% of our revenue. So for a bank, a regional bank, it's a very significant piece. The last quarter was interesting because we had our second best second quarter that we've ever had, and that was in spite of kind of a 3-week hiatus, obviously in the last 3 weeks of April. So we feel pretty good. The backlogs are about where they were coming into the quarter. The one thing that we haven't yet seen the pickup in is a lot of M&A activity, which for us is really important. And I think you'll see a bit of that in the back half of the year. The other thing that's happening out there in the marketplace, we have a very good real estate platform, and I think kind of the bid ask is starting to narrow, and I think you'll see more transactional activity in real estate as well.
Chris, speaking of M&A, there's been a little bit more murmurs about possible bank consolidation. I look at a 5-year chart of your stock. Obviously, you're well off those lows we saw in 23 as there was a lot of concern around commercial real estate, but you're still not near the highs the stock saw, at least back in early 22. Do you see yourself participating at all if there was a wave of bank consolidation, either as a buyer or seller?
We're not really focused on depositories at this point, David. We've got a great opportunity for organic growth. We have a pretty good track record of actually going out and buying entrepreneurial businesses, boutiques, and successfully integrating those. We're investing a lot in people and technology. I do think we're on the front end of some consolidation in the banking industry, but that's not a huge area of focus for us just because I think we've got some pretty good organic opportunities right in front of us.
Chris, obviously a lot of enthusiasm around this sort of deregulatory period on financials in general, but do you get the sense that the industry is going to feel free to step on the gas on fees when there's been some discussion in the sell side just about on where fee trajectories are right now?
Yeah, I actually think that I think it will continue to accelerate, and I do think the regulatory environment will be helpful, not necessarily just around banking, but just the opportunity around, I think, faster turnaround on mergers and merger approvals. I do think I think dereg is a big thing for the economy, and I also think obviously it's a big thing for our industry. I think it'll be helpful.
All right, so where are you on crypto? Yesterday on the show, PNC announced that they're going to have a partnership with Coinbase. Schwab was on the show talking about how they're going to launch a Coinbase competitor. Now that we have some regulation here around stablecoin and crypto, how are you feeling about getting in and using it as potentially a platform and option for your clients?
I mean, it's early, but I think it has a lot of promise, and particularly around stablecoin. And obviously, the Genius Act was just last week. But when you think about stablecoin, there's really a few things. There's the institutional piece, which will be the equivalent of like prime brokerage. That will be dominated by a single handful of international banks. The huge volume, relatively narrow margins. That's not really an opportunity or a challenge for us. The next is as a storer of value. And clearly, to the extent, Sarah, that our clients want it and they want to hold it in their wallets, we will accommodate that. And so we'll be sure to do that. Then there's the sort of discussion around, is it going to cannibalize deposits at banks? I actually think that's a fair, I think it's a threat, but I don't think it's an immediate threat. And I think the industry will respond. I mean, whether it's with tokenized deposits, which I think you'll see banks like Key do, and you may well see, I don't envision Key issuing a coin per se, but I could see us as part of a consortium of banks that issues a coin. And then I think the two best applications are really international payments. Right now, international payments are sort of this Byzantine approach of all these correspondent banks. It takes a long time. There's a lot of friction. I think stable coins could be a really good solution for our clients. It could be faster, cheaper, better. And then last is just programmable payments, which every bank needs to do, whether it's escrows or other programmable payments. So I'm actually, particularly on those last two applications, I'm pretty enthusiastic about it.
Yeah, it sounds like you're thinking a lot about it and what it looks like in terms of the future of banking. Thank you, Chris. We appreciate it. It's really good to talk to you. Chris Gorman, CEO of KeyCorp.
Meantime, Texas Instruments on pace for the worst day in several years, sitting at the bottom of the S&P today. We'll talk about why after the break. Later on, the CEOs of Oklo and Liberty Energy fresh off this new partnership to help address the country's ballooning energy needs. When we come back.
viciously.
Welcome back to Squawk on the Street. About 30 minutes into the hour, here are three big movers we're watching today. Results out of Texas Instruments hitting the rest of the semis after the chipmaker gave weak guidance. Executives saying on the call that customers remain cautious, especially in the U.S. GE Vernova leading the S&P after raising guidance and beating estimates thanks to some strength in their power and electrification businesses. And fintech player Fiserv is heading lower after a cut to its organic revenue guide. Company also announcing plans to acquire part of TD Bank's merchant processions business in Canada.
All right, let's get a CNBC News update. Silvana now has that for us. Silvana.
David, good morning. The sentencing hearing for the man accused of brutally stabbing 4 college students in their home near the University of Idaho in 2022 will begin soon. Brian Kohberger admitted to the killings earlier this month as part of a plea deal to avoid the death penalty. The victims' families and others will be able to provide impact statements today in a hearing that is expected to last most of the day. The Israeli military says its forces accidentally hit Gaza's only Catholic church last week in a strike that killed 3 people and injured 9 others. The attack drew international condemnation, including from the Vatican, and prompted President Trump to call for an investigation. Israel's military said the strike was a misfire. And Tom Hayes, the first trader ever jailed for interest rate rigging, saw his conviction overturned today by the UK Supreme Court. The judges said the jury in his trial was misdirected, so his conviction could not stand. A jury found him guilty in 2015 on 8 counts of conspiracy to defraud over accusations he manipulated the now defunct benchmark interest rate, LIBOR. Sarah, I'll send it back to you.
Yeah, it was a huge deal.
Yeah.
Thank you, Silvana. Still ahead, a look at one surprising retailer that has been able to avoid tariff costs because they reshored manufacturing back in 2012. And after a break, power demand tied to AI and data centers just keeps on growing. We'll talk to the CEOs of Oklo and Liberty Energy about a new partnership for large-scale, high-demand customers like big tech in just 2 minutes.
insurance.
Nuclear startup Oklo and natural gas firm Liberty Energy today announcing a partnership to provide energy to large-scale customers. The company is setting their sights on powering data centers as AI energy demand keeps ramping up. Joining us to discuss the new alliance is Oklo CEO Jacob DeWitt and Liberty CEO Ron Gusick. It's great to have you, gentlemen. I mean, Jake, we've talked to you numerous times on this show about how you are trying to transition the world into a nuclear-powered future. How are you doing that now with the help of Liberty and a traditional gas company?
Yeah, well, it's great to be back. Thank you for having me again. I mean, that's really is a pretty exciting thing for us. You know, the partnership with Liberty goes back quite a bit. And we see a lot of opportunity in terms of, obviously, a lot of people need power, frankly, not just now, like yesterday, but they need it now. And one of the things that we see as a really important opportunity here is bringing gas in as a bridging solution to nuclear and then playing a very complementary role going forward. And with Liberty's experience set and what they already do, being able to transition that into this space to bring a near-term power solution for data center providers that then can ramp forward and bridge into new nuclear builds that we can offer. It's a huge combination, like a huge sort of offering that makes it easier for customers to get power and in a portfolio mix that they really want.
So why, Ron, why do you need Oklo to do this? Why can't you just immediately power with gas now those data centers?
Good morning. Certainly that is the case. We can make that immediate step with natural gas fired infrastructure today. But this allows our customers on the data center side or elsewhere a path towards a more comprehensive solution, a lower carbon intensive power generation mix where we have nuclear as the base load capacity. We have natural gas on top of that. So provides us that speed to market opportunity, provides us that long-term path to the outlook that they would like to see, and ultimately some real flexibility in how we think about the long-term solution when we have grid availability as a piece of that puzzle as well.
Ron, is this a template for what you see going forward in the industry, these kind of partnerships?
I certainly think it is. I think there's a real benefit to having baseload nuclear capacity alongside of the flexibility of natural gas. We know that natural gas has that ability to come on and off relatively quickly, and so there's that opportunity to take advantage of, for example, maybe some low-priced grid power when there's abundant wind and solar there, and to the extent the prices on the grid maybe aren't so attractive, we fire back up the gas power alongside the nuclear. So I think that comprehensive solution looks like a very good portfolio as a path forward for many of these large industrial users that are looking for power today.
Jake, I think you've had a longer running relationship here with Liberty as an investor, but I'm curious what sort of other partnerships you have with the oil and gas industry at this point.
Yeah, I mean, this is one of the cool things, right? We first got to know Liberty actually, through former CEO Chris Wright back in early 2023. And then spent a lot of time with them. They got pretty excited about what we were doing and made a strategic investment in us at the time, seeing the path ultimately for opportunities like this, where they could bring the things they can bring to bear with respect to their expertise and experience on sort of field operations and services, coupled in with this kind of longer term power play. And I think what their experience said is bringing power to sort of the oil and gas field operations really matches well with being able to be a pretty turnkey provider that integrates well with what we're doing for data center providers. And I do think there's interesting templates like this across the oil and gas space. I mean, we're very excited about having a partnership with Diamondback Energy, looking at bringing electricity, or basically helping electrify their operations down in the Permian. But there's a lot of opportunities coming forward, like beyond this, as we think about sort of, hey, we need to find creative power solutions, and it's going to look different, right? Most customers can't just look at the grid as an option. They're having to look at these sort of combined solutions that bring a nuclear, as sort of a baseload long-term solution with the right ramps that gas can bring forward. And then there's a lot of flexibility that offers customers. And when you sort of couple that in the right way, in the right sizes, it really does make I would say, a faster to market opportunity to bring power to folks who need it right now, with the long-term sort of sustainability that they have in mind that a nuclear solution offers. So Liberty's expertise here is a fantastic sort of partnership opportunity for us.
Ron, we always like to ask how regulators are thinking. We kind of know what's coming from the federal level and the big tailwind there. But are there elements of regulatory friction at the local level or the state level?
I think those are always things we have to navigate, but I think we're having a more pragmatic conversation around energy and the importance of that today. We have maybe had some policy decisions in the past that have got us in a bit of a challenged position, but I think there's a recognition that AI is going to be a very, very important part of our world, reshoring manufacturing, critical minerals mining, things like that are relatively energy intensive here in the United States. And I think we're seeing now a recognition amongst policymakers, the regulators, that we have to find a path to enabling the supply of energy that's so important to enabling these industries. So I think we're starting to see a lot of support in that regard. You've heard from the administration, really the use of the term that this is our next Manhattan Project, winning the AI race. And so I think with a mandate like that out there, we've got a lot of support, a lot of tailwind behind us to start to build the energy infrastructure necessary.
Well, I'm curious. I mean, Jake said, of course, it's needed now. What are you seeing on the ground right now, Ron, in terms of needs for data centers, for example, as we watch, Abilene and Louisiana and all of our hyperscalers just building at an enormous pace, not to mention, obviously, OpenAI and all the competitors there. Are you going to be able to meet it near term in terms of the power needs? Or we?
That's a very good question. Of course, as you highlighted, lots of demand there. It's coming fast and furious, and it's coming in a wide variety of states. I think ourselves, Oklo, and many of our supply chain partners working hard to ramp up capacity to be able to meet that demand. You're hearing the people who are in the space around actually manufacturing the generation capacity, whether that's natural gas recip or turbines, working hard to scale their supply chains and ability to meet that need. We've got the nuclear team working hard to get across the finish line and be able to deploy that as a part of the solution. And so I think we've got a lot of great things going for us here, and certainly lots of people working in the right direction. Are we going to get there maybe as fast as we hope? Maybe not quite, but I would never bet against the United States in this.
Well, I think it also helps that your former CEO is now the energy secretary, as was alluded to. And Jake, as we've been talking about with you guys, the federal, the executive orders, the partnerships, it's all building momentum for your company. As I ask you on every interview, how close are you? And what has happened to the timeline to sort of going live with these reactors?
Yeah, I mean, it's evolving still in an exciting way. But I think one of the things we see is obviously the executive orders help support like sort of solving the two biggest timeline drivers for us, right? One is the regulatory piece, the permitting timelines, and then the other is fuel availability. And so we're taking, sort of advantage of what this opportunity looks like to see how much we can actually push things to the left, right? Not to the right. Right now, the NRC, the Nuclear Regulatory Commission, has made it clear they expect reviews to be in 18 months, not the 24 to 25 we were expecting. So that could be a 6-month acceleration alone. Additional permitting accelerations from what we have to do to site facilities with DOE authorization, and they are expected to accelerate as well, and that's important for fuel fabrication. And then on fuel procurement, they've opened the door for significant, abundant reserves of material that right now is just a waste asset, including some of this excess plutonium that could be a really useful fuel in reactors like ours that was just going to be thrown away, but could be worth 3 to 4 gigawatts of power capacity going online. So that opens the door to go sooner, faster in terms of scale. So we do expect there to be significant benefits on building more plants sooner. That first plant, it's still kind of got some constraints on how fast it can get out, which we expect 27. But what I think is really exciting is this puts us in a position to build more follow-on plants more quickly, and that's what really matters. Obviously, getting that first plant built is important, but scaling and ramping beyond that is what's really critical. And so we feel pretty excited about that. But look, it's still evolving, and we still see some benefits and some tailwinds to move this to be faster.
Well, Wall Street's excited about it. Today especially, we're up 10% on Oakland, almost 20% on Liberty. Guys, thank you so much for joining us to discuss the news of the day. Jake
Thanks
and Ron.
so much.
Thank you. Appreciate
Speaking
it.
of all of this, the White House is releasing today its AI action plan. For that, we're going to turn to Eamon Javers. Morning, Eamon.
Yeah, good morning to you, Carl. The White House releasing this plan. It's a 28-page plan, just posted it on their website, and officials briefed reporters just over the past half hour on it. Take a look at a couple of the highlights here of what the goals are for the administration in terms of AI. They're talking about partnering with industry to deliver AI export packages. That is, they want American AI to be the default AI system around the world, countering China. So the idea here is to export entire packages of AI so that American AI can set the standard globally. They want to expedite and modernize data center permits, really focused here on environmental regulations that they feel are in the way of creating those data centers, removing federal regulations, hindering AI development. Again, that's largely about these environmental restrictions that are slowing the growth of the industry, they say, and then also upholding free speech in the new models. And this one is largely around DEI. Officials briefing reporters just now from the Trump administration say they don't want DEI built in to AI models. They say they want accuracy, fairness, and truth in AI, and they don't want any ideological agendas built in. I asked officials on a call just now, who is it who's going to decide what's an ideological agenda and what's not? That can be a tricky thing to do. And they said largely what we're focused on here is DEI and making sure that that's not built into these models. So, guys, a whole host of new details released on the website. And also we're expecting some executive orders from the president later this afternoon. And we're expecting the president to make a keynote address about all of this in the 5 p.m. hour. So we'll monitor that as well. Back over to you.
Yeah, a lot of these are reversals from the Biden AI EO. Eamon, is there any let up in the requirements for these AI organizations to submit any kind of safety or security reports?
Yeah, I haven't seen that yet. I mean, they just released this 28-page document a couple of minutes ago, so we're going through that now. But, it seems, Carl, broadly here, that the discussion around AI has sort of left that safety issue in the dust, and it's full throttle ahead in terms of AI development.
Some pats on the back for open source. We'll get a lot more detail, as you said, Eamon, as we work our way through that document, and we'll hear from the president later on today. Next hour, we'll talk more about the White House's AI plans with the administration's federal chief AI officer. And then after the break, home builder stocks coming off their best day since 22. Some downbeat signals crossing on the housing market today as we got existing homes. We'll talk about that when Squawk on the Street continues. Home builders raising the roof after beating earnings estimates. The home builder ETF coming off the best day since 22. Of course, Horton and Pulte both jumping double digits. But earlier this hour, we did get existing homes, and we saw a big miss, down 2.7 month on month in the month of June. Joining us here at Post 9 is UBS home builders analyst John Lovallo. It's great to have you back, John. Welcome.
Thanks, Carl.
Were you taken, I mean, we were trying to figure out yesterday if this was about incentives working or just people moving on with their lives at these rates. What happened yesterday?
I think it's a few things, right? I think consumer confidence is beginning to improve, which will potentially bring potential buyers off of the sidelines, which is a very good thing. But just as importantly, investor sentiment is starting to improve. And I think that there's a view that this quarter will represent the last cut for the home builders. And I think as we move into 2026, there's growing optimism that the housing market is actually going to improve. And so it's a combination of that and positioning that drove the move.
So not necessarily hopes for a relief in rates, for example.
We're not forecasting that at all. In fact, I don't think we need it. I think what we need is stabilization in rates. With this volatility, it's very difficult for the home builders to plan a business. It's very difficult for consumers to make a decision on, the biggest purchase of their lives.
Right. So are they doing anything tactically regarding the makeup of a house or square footage or the amount of yard you get, anything like that that will entice buyers?
I think the builders have been very creative and very reactive and responsible in how they're handling the market. They're building smaller footprints, fewer SKUs, if you will, so fewer floor plans, which just makes the build process much more efficient. And they're doing it in smaller footprints that are more affordable. And on top of that, offering financing incentives for the buyers that's helping to kind of solve for that affordability equation.
We, of course, keep watching. I think, what's lumber up for the year? 30%?
20 to 30.
Is that manageable?
We're still in the 420, 425. It's in a very decent range. Interestingly, stick and brick costs, so labor and material costs for the home builders, are actually down on a year-over-year basis by low single digits. So again, the builders have been very efficient and very productive in the way they're managing the business.
What about this idea that the president floated yesterday when he was taking questions with the president of the Philippines about eyeing, eliminating capital gains for selling homes? Is that possible?
Anything's possible in our world today. I think, look, anything that puts incremental dollars in the hands of the consumer is a positive. Now, whether that's reducing the SALT, or increasing the SALT deduction or tax breaks, things of that nature, anything that gives more money to the consumer makes a home purchase more palatable.
But with that, do you have any sense of how stimulative that could be for the housing market?
We haven't run the numbers yet, but yeah, clearly it could be accretive, but we don't have the numbers offhand.
All right, so what about the stocks themselves? And we mentioned D.R. Horton reported, I guess, yesterday. Stocks down 15% over the last year. Obviously strong yesterday, but down today. What's the beneficiary, to the extent there is one right now, given the environment you described?
Yeah, look, I think most of the public builders are very well positioned to continue gaining share, for one, from the public builders. They're now, the top 16 builders are about 50% of the market. So they have a lot better access to land, labor, materials, and financing. Plus, they have the balance sheets to offer, the financing buy downs for the builders. For the buyers. So I would say that the home builders in general are very well positioned. We still like the low end entry level. So that would be a D.R. Horton, as you mentioned, or a Meritage Homes that reports later today.
Finally, is immigration or labor availability, is that material to results lately?
Look, there's a real shortage of labor in the market. That's been going on for a decade. But this incremental kind of immigration crackdown has really not caused any disruption as of yet. Not to say that it won't as we move forward, but so far so good on that front.
Right. Certainly a lot of inputs to keep in mind. And we always say housing punches above its weight when it comes to the economy.
That's right.
John, thanks. Good to see you.
Good to see you.
John Lovallo.
Well, as companies navigate fast-changing tariff headlines, one retailer has insulated itself. It's been reshoring most of its supply chain to the United States. And it did it more than a decade ago. Courtney Reagan joins us. She has that story for us. Courtney.
Hi, good morning, David. So right here, this is where all four components of Bath & Body Works foaming hand soap come together. So the bottle itself is made in a nearby facility in Central Ohio. It goes into this machine where automation then fills the pump, or the bottle rather, with the soap. The pump is then added. It's screwed on, and then a label is added at a rate of 270 bottles a minute. There is an employee at the end of the line that is here for quality control. This facility alone produces about 250 million units every year for Bath and Body Works. 80% of what the retailer sells is made right here in the United States, and every finished product that is sold here is made here. In Central Ohio, it makes up about half of all of that production.
The chemists and the bench people in here are working to bring fragrance and formula to life, and then they plug in very tightly in a concerted way with all of the vendors that are within our walking distance of this facility, transferring from product development into manufacturing.
It's all part of Beauty Park, where around a dozen vendors produce mainly for Bath & Body Works, just 10 miles from corporate headquarters. Now, this foaming hand soap used to travel 13,000 miles between China, Canada, and Virginia and take more than 3 months from manufacturing to distribution. Now, it's less than 11 miles and 3 to 4 weeks. Now, the retailer has been making products here in Central Ohio for more than a decade, but it took 2 years from the ideation of Beauty Park to actually begin that manufacturing, and hundreds of millions of dollars of an investment, largely from its vendor base as well as local, state, and federal government to pull it off. Back to you guys.
Well, it's certainly proving worth it for them. Now, with all these tariffs, can others do the same? Can the big companies, Estee Lauder, others that are in the similar categories?
Absolutely, it is really paying dividends right now, even though tariffs, as you point out, was not the reason for this initially. I asked that very question, can this be replicated by others in retail? And the question was, well, probably, but of course, actually pulling it off is really difficult. It really depends on the category you're operating in. So potentially more likely for consumer packaged goods, less likely for apparel or electronics. Part of that has to do with the raw materials. Part of it has to do with the labor. There's more cut and sew manual labor involved in apparel, whereas here, this is largely automated. Yes, there is definitely a human touch, and that is important, but automation has been a really big part of this, and the weight of the product itself. It makes more sense to have it closer to your end consumer because of the cost of freight if you were to do so far away. All of that, of course, adds to the cost of distribution, and they've figured out a way to make this work.
Yeah, I mean, you kind of hit on my an answer to my question, but you mentioned automation, Courtney. I mean, a key goal of the president's reshoring initiatives is to create jobs. Here, I see a person behind you now, but that's the first person we've seen. I mean, you've indicated, obviously, there's not that many people who work there. I would assume it's a lot of robotics, a lot of automation, and that would be the case for all the reshoring, conceivably, at least in certain industries, it takes place.
Yeah, that's absolutely true. But we also were in a lab yesterday. I mean, there are chemists that work here that formulate the actual stuff that's in the bottles, right? So it's not just the factory. I mean, so much of what goes on in what ultimately comes out in that product does start here. There is still some work that is done overseas when it comes to the perfumers, for instance. That some of that does still come from Europe, but there are other jobs besides the ones that would actually be in putting that final product together for it to go to distribution.
I know Becky made an "I Love Lucy" joke. It's also like a little Laverne and Shirley with that production line behind you.
A little bit. I mean, I'm not going to try to eat any of this, but it does smell good.
Courtney, thanks. And great stuff, Courtney Reagan, this morning. Coming up in the next hour, we'll talk about trade and Tesla. Two big questions for investors as we go into the print. Money Movers begins after this.
Plus.